Have you ever wondered how some of the world's wealthiest individuals maintain and grow their fortunes, even in the face of market volatility? While stocks and real estate often steal the spotlight, there's a more subtle yet equally powerful investment tool that savvy investors swear by: bonds. Here's something fascinating. In 2021, the global bond market was valued at over $128 trillion, surpassing the global stock market. This massive market offers opportunities for steady income and financial security that many overlook. But how do bonds work, and why are they considered a cornerstone of a balanced investment portfolio? Welcome, viewers, to Satoshi Finance, where we navigate the complexities of the financial world to empower you on your journey to financial freedom. In this video, we'll unravel the mysteries of bonds, exploring their basics and strategies for investing in them. So, stay tuned as we dive into the world of bonds and discover how you can harness their potential to secure your financial well-being. Bonds are essentially loans made by investors to borrowers, which can be governments, corporations, or other entities. When you purchase a bond, you are lending money to the issuer in exchange for regular interest payments over a specified period. At the end of this period, known as the maturity date, the issuer repays the bond's face value, also called the principal. Bonds are considered fixed income securities because they provide a predictable income stream, typically through semi-annual interest payments known as coupons. Here's how bonds work. The issuer, which could be a government or corporation, needs to raise capital for various purposes such as funding projects, expanding operations, or refinancing debt. The investor, on the other hand, is looking for a relatively safe investment that offers regular returns. The face value of the bond is the amount the issuer agrees to pay back at maturity. The coupon rate is the annual interest rate paid on the bond's face value. For instance, a bond with a face value of $1,000 and a coupon rate of 5% will pay $50 in interest annually until it matures. Bonds come in various types, including government bonds, corporate bonds, and municipal bonds. Government bonds are issued by national governments and are generally considered the safest, while corporate bonds are issued by companies and often offer higher yields to compensate for higher risk. Municipal bonds are issued by state or local governments and often provide tax-free interest income to investors. Each type of bond has its unique characteristics and benefits, catering to different investor needs and preferences. Bond pricing can be understood by looking at a few key concepts: face value, market value, premium, and discount. The face value, also known as par value, is the amount the bond issuer agrees to repay the investor at maturity. However, the market value of a bond can fluctuate based on various factors. When a bond is sold for more than its face value, it is said to be trading at a premium. Conversely, if it is sold for less than its face value, it is trading at a discount. These price changes are primarily driven by the bond's coupon rate compared to current market interest rates, as well as the bond's credit rating and time remaining to maturity. Several factors influence bond prices. One of the most significant is interest rates. When interest rates rise, existing bonds with lower coupon rates become less attractive, causing their market value to drop. On the other hand, when interest rates fall, existing bonds with higher coupon rates become more valuable, pushing their prices up. Additionally, the credit rating of the bond issuer affects bond prices. Bonds from issuers with high credit ratings, indicating low risk, typically trade at higher prices than those from issuers with lower credit ratings. The time to maturity also plays a crucial role. As a bond approaches its maturity date, its price tends to converge with its face value. The relationship between bond prices and interest rates is inversely proportional. When interest rates go up, the prices of existing bonds tend to fall, and when interest rates go down, the prices of existing bonds usually rise. This happens because new bonds are issued with coupon rates that reflect the current interest rates. Therefore, if new bonds offer higher returns, the older bonds with lower coupon rates must decrease in price to offer a comparable yield to investors. This dynamic is crucial for bond investors to understand, as it affects both the potential returns and risks associated with bond investments. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Investing in bonds offers several benefits that make them an attractive option for many investors. One of the primary advantages is the steady income they provide. Bonds typically pay interest at regular intervals, known as coupon payments, which can offer a reliable source of income. This predictability is particularly appealing to retirees or those seeking consistent cash flow. Additionally, bonds are generally considered safer investments compared to stocks, especially government bonds, which are backed by the full faith and credit of the issuing government. This safety makes them a preferred choice for conservative investors looking to preserve capital. Furthermore, bonds can diversify an investment portfolio, helping to spread risk across different asset classes and potentially smoothing out overall returns. When compared to other investment options like stocks and real estate, bonds have distinct characteristics. Stocks offer the potential for higher returns, but come with greater volatility and risk. Real estate can provide substantial appreciation and income through rents, but it requires significant capital and entails property management responsibilities and market risks. Bonds, on the other hand, offer more predictable returns and lower volatility, making them a valuable counterbalance to the higher risk and reward profile of stocks and real estate. In a balanced investment portfolio, bonds play a crucial role. They can reduce overall portfolio risk and volatility, as bond prices often move inversely to stocks. During periods of economic downturn or market turbulence, bonds can act as a stabilizing force, preserving capital and generating income when other investments may be underperforming. By including bonds in a diversified portfolio, investors can achieve a more stable and resilient investment strategy, aligning with long-term financial goals and risk tolerance. One common approach to investing in bonds is the buy and hold strategy. This strategy involves purchasing bonds and holding them until they mature. The primary advantage of this approach is the predictable income stream it generates through regular coupon payments and the return of the principal at maturity. Investors can rely on these fixed payments to meet their financial goals, making it a straightforward and low-maintenance strategy. However, the main risk associated with this strategy is interest rate risk. If interest rates rise, the value of existing bonds with lower coupon rates may decline. Nonetheless, if the investor holds the bonds to maturity, this risk is mitigated as they will receive the face value back. Another popular strategy is bond laddering, which involves purchasing bonds with staggered maturities. For example, an investor might buy bonds that mature in 1, 3, 5, 7, and 10 years. As each bond matures, the proceeds can be reinvested into new bonds at the longer end of the ladder. This strategy helps manage interest rate risk by providing regular opportunities to reinvest at current rates, potentially capturing higher yields if rates rise. However, the downside is that in a declining interest rate environment, reinvested funds may earn lower returns. The barbell strategy is another technique used by bond investors. It involves splitting investments between short-term and long-term bonds, with little or no investment in intermediate-term bonds. This approach aims to balance the higher yields of long-term bonds with the liquidity and lower risk of short-term bonds. The short-term bonds provide flexibility and cash flow, while the long-term bonds offer higher income. However, this strategy carries risks, such as potential interest rate changes impacting the long-term bonds more significantly, and reinvestment risk for the short-term bonds if interest rates decline. Each of these strategies carries its own set of risks. The buy and hold strategy is susceptible to inflation risk, which can erode the purchasing power of the fixed income. Bond laddering and barbell strategies can help manage interest rate risk, but may expose the investor to reinvestment risk, where future bond purchases may yield lower returns. Additionally, all strategies carry credit risk, which is the possibility that the bond issuer may default on payments. Understanding these risks and how they interact with each investment strategy is crucial for making informed decisions in bond investing. Buying bonds involves navigating various options to suit individual investment goals and risk tolerance. Investors can purchase bonds directly from issuers, such as governments or corporations, through auctions or primary offerings, which may provide access to a wider range of bonds and potentially better pricing. Alternatively, buying through a broker offers convenience and access to secondary markets, where investors can choose from a selection of bonds based on their specific criteria, though this may incur brokerage fees. For those seeking diversified bond exposure without the need for individual selection, bond mutual funds and exchange-traded funds, ETFs, offer attractive options. These investment vehicles pool funds from multiple investors to purchase a diversified portfolio of bonds managed by professional fund managers. Bond mutual funds provide actively managed portfolios, while bond ETFs offer passive index tracking strategies, each with its own set of advantages and considerations. Key considerations when purchasing bonds include assessing credit risk, interest rate sensitivity, and investment time horizon. Evaluating the issuer's creditworthiness, understanding the bond's maturity and coupon structure, and analyzing prevailing interest rate conditions are essential steps. Additionally, investors should consider their liquidity needs, tax implications, and overall portfolio diversification when selecting bonds. By carefully weighing these factors, investors can make informed decisions to build a bond portfolio aligned with their financial objectives. In conclusion, understanding the risks and strategies involved in bond investing is paramount for any investor seeking stable returns and income. We've explored the various risks associated with bonds, including credit, interest rate, inflation, reinvestment, and liquidity risks, emphasizing the need for careful consideration and risk management. Additionally, we've examined the different avenues for purchasing bonds, from direct purchases to brokerage services and investment funds like bond mutual funds and ETFs, each offering unique benefits and considerations. It's crucial to underscore the significance of conducting thorough research before making any investment decisions. By understanding the intricacies of bond markets, assessing individual risk tolerance, and aligning investments with long-term financial goals, investors can make informed choices to build resilient portfolios. Furthermore, seeking professional financial advice can provide valuable insights and guidance tailored to individual circumstances, ensuring that investment strategies are well-informed and aligned with broader financial objectives. Remember, knowledge is power in the world of investing, and taking the time to educate oneself and seek expert advice can significantly enhance investment outcomes. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content, and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.